So we've just had the Chancellor's budget, which saw the OBR release its report with the main facts and figures ahead of the main event in an unusual series of events. The Chancellor was walking a tightrope between appeasing the markets and her Labour Party, and the immediate market reaction suggests she may have pulled this off. But to help us unpack all of this, I'm joined by rates trader Shriya Samarth. Thank you for joining us, Shriya.
Thanks for having me.
So heading into this budget, there was a lot of attention on the gilts market. So let's start by telling me, if you can, why the gilt market is so sensitive to the budget compared to, for example, in the US.
Yeah, the gilt market is very differently operating than the US Treasury market, and a lot of that has to do with the concept of borrowing costs and how they're treated in one jurisdiction versus the other. And I can speak to that firsthand because I'm American. I actually moved to London a little over 10 years ago, and at the time my friends and family were very concerned for me. They said, you're never going to see any sunshine and you're going to pay a lot of taxes. And both of those things are unfortunately true. I haven't seen the sun in a while, and I do pay a lot of taxes. And those taxes are necessary in a way because the UK is very susceptible to borrowing costs, where the US isn't so much. Obviously, the US is also running very high debt right now, but it's also the global reserve currency, which means that there's a lot more outlets for that debt. It's a bigger debt market, and you have a lot more demand there, a lot more resilience and flexibility that UK gilts simply don't enjoy. They're a smaller market substantially, and they're also subject to volatility as a result of that because they don't have as many foreign investors on an absolute basis. So gilts tend to react quite significantly whenever there's the slightest whiff of volatility, and today's event was a great example of that.
So what was the impact on the gilt market, the wider bond market, during the budget?
So the budget in general was broadly in line with expectations. A lot of the data that came out of it was well known to the markets in advance. The biggest shock was probably the 30-minute early release. I think a lot of traders were probably going to grab lunch really quickly and then got notifications thinking, oh, actually the data's already out. Created quite a shock. But the content in and of itself was pretty in line with expectations, maybe even a little bit positive as gilts did start to rally a bit. So we got data such as we're getting a 26 billion net increase in taxes. A lot of that is going to be savings and dividends tax with a 2p increase across the board. There's been a decrease in growth forecasts over the next year from 1.9 to 1.4. Inflation's not quite hitting 2%, but it's still expected to get there for 2027. And notably, the government is planning on reducing its borrowing, halving it actually by 2031. All of these things were relatively net positive for the markets, a lot better than expected. But diving into them, gilts certainly had quite a journey. And to talk about that journey, I think we need to look back to what happened 2 weeks ago. We had a big gilt sell-off because Chancellor Rachel Reeves had initially planned to increase taxes by about 1 or 2p ahead of the budget to sort of plug the fiscal gap. But then she made a U-turn on November 14th and gilt sold off massively. Gilt yields reached 4.6% in the 10-year space, which is a psychologically concerning level because that's the point when you're thinking, hang on, borrowing costs are getting a bit too much given that the deposit rate isn't quite there and is expecting to be cut down. So gilts sold off because they were concerned that if there's no tax revenue, how is this fiscal hole, which was expected to be 20 to 30 billion at the time, how is that going to be plugged? Eventually, news came out that the OBR was expected to produce some positive growth forecasts, and therefore the hole wasn't that big, and gilts sort of corrected, but they didn't quite correct back to where they were. So 2 weeks ago, gilts ended up at 460. They were at about 440 to 442, and then they kind of landed around 4.5% in the 10-year space before the budget began. And that elevation, even before the budget began, tells me that the gilt market had already priced in some risk. They'd already priced in some borrowing costs going into the budget, and therefore there wasn't a huge shock element unless the budget itself was going to be shocking, which it wasn't. And then we have the actual budget. More importantly, the leaks and the order in which they happened. So the first leak was that growth forecasts were slashed, that GDP was slashed by 0.3%. And that immediately led to gilt yields tumbling and a significant rally. In the 2-year space, we saw gilt yields falling 5 basis points instantly. And in the 10-year space, it was 7 basis points instantly. So really significant movements, which then corrected because the second leak came out that Rachel Reeves had found 22 billion of fiscal headroom, which was more than double what she'd left herself last time. And that was a really positive development. So gilts yields corrected back, yields went back up to where they were, and they kind of fluctuated throughout the budget, ending in a slight rally as they caught a bid, led by the front end, which anticipated some rate cuts, fueling some demand. And then later on throughout the budget, the long end, the 30-year space, also caught some bids. And overall, we saw a bit of a rally as the markets thought, hey, this isn't too bad. The government seems to be acknowledging that we have a debt problem, that we have a growth problem. And while there's some nuances in that, overall, it was perceived as a not terrible budget.
Yeah, completely. And I think it's so true what you said. There was so much in the frame of sort of leaking and speculation, even in the weeks beforehand. So there wasn't actually any really element of surprise by the time Rachel Reeves actually started talking. But what were your biggest takeaways from what she was saying?
I think the first main takeaway is that the government is finally acknowledging that there is a debt burden that needs to be addressed, and we can see that through a very critical data print, the public sector net borrowing figure, which the OBR predicted is going to reduce from 138 billion down to 67 billion by 2031. The government is finally admitting, yes, we're taking on too much debt and not bringing enough revenues to generate that. So that's a positive sentiment that the markets have definitely digested. That being said, the tax burden reveals how high the cost of that debt really is. And there was a statistic that came out that the tax burden is expected to be 38% of GDP, which is the highest ever on record, and records began post-World War II. So that's a pretty high burden for the economy to take, for the average person to take. And I think that's going to lend itself to questions that even though the government is doing what it can to reduce all that borrowing, there's going to be questions on what about productivity, what about growth? When are those two going to step in and pull their weight? The second main takeaway, I think, actually has less to do with the government and more to do with the Bank of England. The Bank of England preemptively provided a cushion with an adjusted rate path that allowed for the budget to get away with a bit of leeway no matter what came out, even though we already knew a lot of what was going to be published before it did come out. So the Bank of England's rate path was initially pricing in a terminal rate of about 3.75% back in early October. But in that month or so, we've seen that rate path really accelerate with an additional rate cut priced in. And now we're expecting the terminal rate mid-2026 to be 3.25 to 3.5%. A lower rate path obviously spurs growth. It's good for companies that need to borrow. It's good for mortgages. And that rate path being there, lower now, has been persistent, even though the latest CPI print was down slightly at 3.6 versus 3.8. That lower rate path is almost a cushion that allowed the government to get away with whatever the budget couldn't deliver. It effectively proved that the Bank of England's going to step in where the government necessarily couldn't. And we've seen that precedent before. The Bank of England is supposed to be independent, so this shouldn't really be happening, but the market is pricing it in anyway, because after 2022's mini budget under Liz Truss, the Bank of England did exactly that. They stepped in to provide a liquidity backstop for gilts when they were massively selling off to protect the pension industry, even though they were in a tightening cycle. So the markets learned from that and thought, okay, well, if the budget can't deliver, that's okay, because we know that lower rates are going to step in and save us all.
And that's really interesting. And do you think there is an element in there as well that the growth outlook is another reason that potentially the Bank of England could be looking to cut interest rates? I know they focus on inflation, but there has been a sense that maybe the jobs market in the UK is starting to slow. We're starting to see service sector inflation slightly lowering. So there is a sense that maybe the Bank of England could be cutting because the economic picture is deteriorating, in which case that does paint quite a difficult picture for growth for the Labour and the budget anyway.
Of course, and while the Bank of England does not have a strict mandate to focus on anything but inflation, it's really hard to ignore the peripheral noise. We had retail sales come out for October, which was minus 1.1%, and the month before it was a positive 0.5%, so you kind of already see that deterioration kicking in. And even though CPI has been okay and the Bank of England does not need to drastically react, that's going to be on the back of everyone's minds. Why are rates so high if the economy is posting low growth and if forecasts have just been slashed in the budget just now? So it does naturally go into that train of thought. I'm not sure any Bank of England economist would admit that, but that's what the market thinks anyway, that you do have to think about growth, not just inflation. The two are closely linked, but that whole supporting the budget was definitely unintentional. It just so happens that in the past 6 weeks, the lower rate path has allowed for more questions about growth to come up and how maybe someone other than the government could help.
Excellent. Well, thank you very much for your insights once again, Shriya. Pleasure talking to you.
Thanks.
For more videos like this, please do like and subscribe.